18.
Hello and welcome to the CNBC TV18 Investment Guide. I'm Surabhi Upadhyay. Now, if you've been following the market, you would have seen the excitement around power stocks of late. In fact, the Nifty Energy Index is up around 6 to 7% in just the month of June alone. So this gets us to a fundamental question. Is the excitement around the power sector just a bull market phenomena? Or is there something more to it? Is there a fundamental reason why you should once again, perhaps after a gap of many years, start thinking about investing in power stocks? That's the theme on this week's edition of the CNBC TV18 Investment Guide. Let's get started. Well, our experts on the show today are Charanjit Singh, who's a fund manager at DSP Investment Managers. He, in fact, manages, among other funds, their infrastructure fund, as well as Swarnim Maheshwari, VP Institutional Equities at Edelweiss Securities. Gentlemen, thank you very much and welcome to the show. So, I'm going to start with a very basic question to both of you, and that's the question I just put up for our viewers as well. Is this just excitement in the bull market, or is this actually a tipping point for the power sector? Charanjit, I'm going to start with you. Opening thoughts.
Yes, Surabhi. I think that's a very pertinent question for the power sector right now. And what we see is that overall, if you look at the valuations also for the sector, they have been, derated quite significantly over time frame. But the excitement could also be, coming from the fact that government is working towards the positive steps in terms of distribution reforms, which can have a significant impact on the overall, value chain within the power sector. Additionally, we are seeing that the valuations are near average or below historical average, especially for the generation sector. So as you see that these are, regulated utilities, 90% of their, profits comes from the regulated return assets. So in a way, this sector had been beaten down significantly. But as we see that reform agenda from the government side takes a push and DISCOMs see a significant improvement, there could be a turnaround in the overall scenario for the power sector.
Okay, so you seem to be sort of giving it more weightage than just some market excitement. What about you, Swarnim? You track a lot of these power companies in close detail. So fundamentally, is there a reason to believe that business profits and earnings are about to get better?
Yeah, first of all, Surabhi, thanks for having me on the show. So in the power sector, there is much more beyond the bull market exuberance. That is what I would say. I think this is the beginning of twin combinations of a cyclical and a structural recovery, with cyclical being more dominant. And this actually provides a big tailwind to the sector. So we are really banking upon cyclical recovery on the back of a deep industrial recovery on the cards as the private sector CapEx have started to pick up. Now, do remember that this is happening after a decade, and industrial demand is almost about 40% of the overall power demand. And this can have a far-reaching positive implications for the distribution, specifically the SEBs. So going back historically in 2003 to 2008, whenever there is a significant uptick in the industrial recovery, there is significant reduction in the losses of SEBs. And in fact, the losses have reduced from close to about 1% of GDP for SEBs to almost about 0.5% GDP. And that's a very important thing. And also the fact that SEBs, they actually, for them, industrial demand is 40%, whereas the revenues for the industrial customers is almost about 65%. So these are the golden customers for them. And because since they bear the subsidy charges, and hence any reduction in SEB losses, it is likely to rekindle and rejuvenate the entire power sector. So this is from the cyclical side, and from the structural side, as Charan mentioned, there's a lot of ongoing impending reforms. COVID has pushed it a bit, but then it is likely to guide. I think I would just say that the utilities are actually one of the cheapest ways to really play out the industrial recovery. The PSC Power Index is trading at just about 1.1 times price to book, and that's about 35% discount to the last 15 years valuation.
Sure. Yeah. So, I take that point. Yes, these stocks haven't run up as much as the rest of the market, but the question is whether you'll get some growth or not, or else you'll end up being in what are called, value traps, as the market jargon goes. But let's take that point. Charanjit, we just heard Swarnim mention that demand is likely to revive because if there's industrial capex, if the economy is growing, you need power. But will that help Because as we were discussing before the show as well, if you look at the generation side, then we're still in overcapacity, aren't we? I mean, thermal plant load factors have been struggling. They've been in the 50s or so. So is there any point in looking at generation companies to begin with at all? Chandrajit?
Yeah, so if we look at the generation sector, let me give a brief perspective. So when we saw in FY09, then there was peak deficit which had reached in the power sector was almost 11%. And post that, we started seeing a significant addition in the thermal power capacity, additions to the tune of almost around 20 gigawatt per annum of coal-based capacity being added over FY12 to FY16. But from FY17 to 20, what we saw is that this capacity addition actually went down to almost around 5 gigawatt per annum. So what generation sector saw is during that time frame of FY12 to 16, the demand growth was almost around 5%. And then the demand growth on an average fell to around 3.8% from 17 to 20. Now, this has led to a scenario where overall plant load factors have come down from 74% to current 53%. So it means that we have a significantly oversupplied scenario in the coal-based power generation capacity. So what is also happening is that none of the generators are talking about no new greenfield capacity on the coal-based generation. Another important point to note here is that government, looking at the overall environmental concerns which are being talked about globally, is also looking at renewable sector in a big way in the Indian context. Indian government has set a target of 175 gigawatt of renewable energy by 2022. They had upgraded this target to 450 gigawatt of renewable energy by end of 2030. Now, if you see the current mix of renewable energy, right now we have almost around 94 gigawatt of renewable energy and 380 gigawatt of installed capacity for overall power generation. We have 77 gigawatt of incremental renewable capacity, which is either under construction or under the bidding pipeline. But what we see is that we may not be able to achieve the target which has been set by the government for 2022. The reason for that is that we are seeing that the state discoms are shying away from signing the power supply agreements. Mm-hmm. What's also happening is that as PSAs don't get signed, even lenders will find it difficult to do the financial tie-ups for these particular assets. Additionally, what we are seeing on the solar side, that there's a heightened competition. There are almost 12 to 13 bidders participating, so which could also bring in a lot downward pressure on the generation side. Okay. So in a nutshell, to conclude, what we'll see is that both coal and renewable-based capacities will continue to coexist. Mm-hmm. Coal-based capacities will have to ramp down when renewables are available. And that is how the entire, industry will go ahead in the generation space. Okay. For the regulated utilities, already they are, 90% of the regulated assets are giving them the returns. Incremental capacity additions has to come through the renewable sources, where we have to see how the IRRs shape up and the power supply agreements going forward. That's exactly the point that I want to take forward. And Swarnim, come in on this, because as Charanjit told us, I mean, it's great from an ESG perspective, and renewables are the future. And the companies are so upbeat. They keep telling us about the kind of plans that they have. But my simple question is it profitable? If there's a bidding war in tariffs and, you have tariffs sort of coming down and problems with PPAs, Charanjit just mentioned, then what's the business viability? Should we be looking at generation companies at all?
So, Surabhi, of course, what I would just say is that renewable is already making an impact, and ESG theme is getting deep entrenched into the valuation framework. But it will be quite premature to write off thermal, as 75% of India's generation comes from thermal. Now, on your question whether renewables are profitable enough, I think at this juncture, what we have seen is the IRRs for the renewable bidding has actually come all the way down from 14% to something like about higher single digit to lower double digits. That's at the project level IRR. So, there is intense competition out over there, but we do believe that at a lower interest cost, the profitability could change for companies over there. But also do remember that it has not been a smooth sailing for the renewable sector overall for the last 4 to 5 years. And there are a lot of challenges faced by the sector also, because with respect to, say, discom payment issues or adoption of tariff, or there is then change in the duty for the module prices. And I think there is going to be intermittent challenges in the next 4 to 5 years as well, because now think about this, that the module prices have already started going up. So the tariff that we used to see at about 2 rupees per unit for renewable, our sense is that if we are going back to about 2.5 rupees per unit over the next 1.5 year.
Okay. Well, in any case, in India, we don't have a pure play listed renewable company. I mean, very few. Most of them are a hybrid between thermal power and renewables. So we'll come back to the companies and the stocks in a bit. But very quickly, since we're rushing through, we have to do transmission, we have to do distribution as well. So now on transmission, gentlemen, here it's a more sort of plain bread and butter kind of a business. So Charanjit, do transmission companies make sense? And Power Grid has had the monopoly over here. There are some private players coming in. Would you at all invest in the transmission side in the power sector?
Yeah, so Surabhi, I'll comment from the sector perspective. So if you look at the transmission sector and specifically the transmission assets, the most attractive part of these assets is that one, there's a good amount of visibility on the revenue profile for the next 30-35 years. Secondly, there's a low default probability from the discoms on the payments. And lastly, these are low-cost maintenance projects. If you look at transmission as a sector, we have invested heavily in terms of building our national grid. So inter-regional grid, which was at around 28 gigawatt in FY12, has actually scaled up to 102 gigawatt by FY20. What we are also seeing is that the central transmission utility, which is the largest transmission utility, has been consistently doing almost on 20,000 crores of average annual capex over FY12 to 19, while it has not tapered down significantly because of the lack of generation capacity addition and hence reduction in the transmission capex overall. Plus, what we have also seen is that there is a shift from the nomination-based orders to more and more tariff-based competitive bidding orders. So that is the shift which has brought in, like you rightly said, more private operators into this market. So this market has also become more competitive from a longer-term perspective with multiple players now playing in the market.
Okay.
But what will happen in the transmission space in terms of the opportunity size? What we see that going forward, as more generation in the renewable space gets ramped up, we will be required to connect these renewable assets from far-flung areas to the grid, and that will require additional transmission capex. And there the projections are that we may require an investment of almost around 280,000 crores for these kind of transmission investments. Secondly, what we also believe is that as you have multiple sources of energy coming onto the grid, that will also require a lot of grid automation. So grid automation capex will pick up significantly going forward to actually manage these flows of power. So in the near term, we definitely see that capex in the transmission space will remain muted, but it will pick up as we see the generation capex on the renewable side picks up.
Okay, so yeah, I guess with more and more renewable capacity coming in, some amount of upgradation in the grid will also be required. Swarnim, I'm going to ask you about transmission and some of the power InvITs as well in a bit, but we first have to take a very quick break. The conversation will continue on the other side. Welcome back. You are with us on the CNBC TV18 Investment Guide, and this week we are talking about the power sector and whether you should be looking at putting your money to work over here. Well, Swarnim, straight away onto distribution, because here is where so much is happening. From the time we would all discuss these ballooning SEB, State Electricity Board losses, to privatization, and now we're seeing a lot of union territories going in for privatization and distribution. What's take? Is the model working well? So when you're looking at companies like Tata Power, CESC, they're supplying to big circles. Is it all a profitable venture? And should one look at investing here?
Sure. So, first of all, why distribution, why there is a privatization required? So I think the distribution is the weakest link in the entire power sector value chain, and it still continues to be a trough. So there's almost about 5 lakh crores of distribution debt sitting on SEBs. And there are a couple of reasons for that. Of course, there is absence of competition, higher AT&C losses. The tariff setting process is not that economical. And then there is absence of the sunrise technology implementation. Now, there is this very big change that we have started to witness in the last about 1 year, where there is this privatization of circles or the states that has started to happen. See, India's power sector is a concurrent subject matter between both state and the central government, wherein there could be sometimes some issues as some audacious reforms may just not be difficult to implement. So hence, from that perspective, the recent reforms, which is more like the National Tariff Amendment Act 2020, National Tariff Policy, I think these all reforms are directed towards to clear the hurdles and improve the discom finances. And now, on privatization side, I would just say that it's a pretty good template. It's a tested template for a national rollout. We have seen whenever the circle has been privatized, there is a massive reduction in the AT&C losses. And mind you, all these private distribution businesses, they have been profitable. Wherever it is implemented, we have seen the private sector operating an AT&C loss of almost about as low as 7 to 8% in some of the circles. So there is a big opportunity. Out of the 25 to 50 million connections, private sector only has about close to 20 million connections, so just about a penetration level of 8%. And over the next 4 years, we do believe that this gradual privatization will start to actually gather momentum. And we expect an overall opportunity of another about 8 to 10% for private players. That can actually translate into a profitability of close to about 3.5 to 4,000 crores. That's what our case is.
Okay, so you're sounding Swarnim very, very gung. I'm sorry to cut in. I'm sorry to cut in over here because we want to come to the stocks as well. Our viewers want to know your top picks as well. But before that, Charanjit, your thoughts on distribution. And again, we don't have a pure play company here. So what we have are integrated players who will give generation, renewables, some distribution as well. So does this kind of a hybrid model make sense to you?
Yeah, so if you look at the distribution space, the companies which have actually been in this sector are more integrated players, like you rightly said. And these are the companies who are utilizing their cash flows generated from thermal assets to invest into the power distribution sector. What we see is that these companies have turned around these distribution circles very profitably, and AT&C losses reduction has been significant to the tune of almost average less than 10%. And as we see that the government reforms in the terms of Electricity Amendment Act of 2020 gets implemented, there'll be a significant push towards the reforms in terms of the distribution privatization. We see that this could open an opportunity worth almost 6 lakh crores for the market in the distribution space, and integrated players will be the ones who will be able to capture this opportunity. And here again, we have to see that how government is able to do this program in terms of union territories getting privatized going forward. But definitely this is a long-term growth opportunity which we see in the private discom space.
So Charanjit, now sum it up for us. When you're out there to pick a power stock, what are the most important factors you're looking at, and what part of the chain? We've discussed generation, transmission, distribution. What part of the chain are you most bullish on?
So when you look at our framework for investment in the power sector, definitely, the various factors which include our valuations, the return ratios, the regulatory framework, cash flows, and the capex growth. So what we see is that, one, we should not be writing off the power generation sector so quickly because these are, the stocks which are trading below 1 times price to book multiple. Plus, what we are also seeing is that they are now making credible effort in terms of moving towards more and more renewable power. And 90% of the generation assets are getting regulated returns. So as the credibility of move towards the renewable power gets visible to the street, I think that will be the key factor. Transmission space, the growth on the capex will be muted, but this will be a strong cash flow generation business. And that is where the ROEs are decent at around 16%, what central power transmission utilities are kind of making. And when we see their valuation, they are trading at almost historical average price to book multiples. So as the resurgence of the transmission capex happens, we see that that will be positive for the power transmission players. In the distribution space, it's definitely the companies, more integrated players which are there, and their track record in terms of taking these new distribution circles and turning them around in terms of the reduction in the AT&C losses. So I think in these different buckets, we are putting all these companies, and we see that the most important part here is that the discom reforms, which will actually be the key trigger for the re-rating of this entire sector. Apart from this, there are two other aspects in this value chain. What we see is exchanges. So exchanges, right now, the share of exchanges in the power generation is only 6%, versus if you look at the European economies, they are much higher at around 45 to 60%. And here, there's a lot of change or evolution on the regulatory framework which is happening. There are new exchange which is coming up as the regulator wants to broad-base this market. We also see some beneficiaries emerging in the grid automation and the power transmission equipment space as we scale up on those capacities going forward. And these are mainly dominated by large MNC players who have distribution automation systems and grid automation technology with them. Yeah.
Okay,
that's how we look at the
opportunity. All right, so some of the equipment manufacturers as well who are catering to grid automation, that gives us a bit of a clue. Got that. Okay, now we're going to come to Swarnim's top picks, and we'll just put the graphics up. Tata Power, IEX, NTPC, and CESE. These are the 4 top names that Swarnim you've picked up from the whole power sector pile. Explain to us why. Let's very quickly go over each stock one by one.
Sure. So just starting with Tata Power, I think it's a very good integrated play on the overall recovery in the power sector. And this has actually deep presence across the entire value chain. And then you have this renewable presence and furrow into the newer businesses, which is EV or microgrids. It kind of makes it a very good play. We have been positive all the way from 30, but we do still believe that at 120 levels also there is still a good amount of upside left. And then you have, of course, renewable monetization, which is actually a key trigger for the stock. Second, I would just say for NTPC, it's in a transition from thermal to renewables. And then the higher power demand, which actually could lead to a positive re-rating for the stock in the near to medium term. Do remember that the stock is available at a 50% discount to its last 15 years average price to book value multiples. So again, there's a deep value sitting out there in NTPC. CSE, they have chosen distribution as the only growth option for themselves, and that too without getting aggressive. So in our view, like we just discussed, the distribution space is one space which is likely to gain a lot of traction. And this company is going to be a key beneficiary of the same. Then you have, of course, a strong balance sheet, attractive valuations, high dividend payout. That's also, the other key positives. Finally, on IEX, a kind of a monopoly business model for them in the power exchange market. And then it's also a key beneficiary of the regulatory changes with respect to the deepening of the short-term power market by adding a lot of new products, which will double the opportunity. And in IEX, there is also a very interesting story, which is a vertical diversification that they have done by setting up a gas exchange, where the opportunity size could be as big as about 3x of the overall power exchange. So yeah, that is what that will be our top 4 picks.
Okay. Charanjit, before we wrap up, just on the regulatory front, I think both of you mentioned a couple of important reforms ahead, which is the new electricity amendment bill, of course, and this tariff policy. So help us understand this. What changes as the new tariff policy comes into play? Are we generally looking at higher costing power from a consumer standpoint? And then who will be the biggest beneficiary? Will ultimately the benefit go to the generators more than the distributors?
So, Surbhi, if you look at the Electricity Amendment Bill 2020, so what we are seeing is that it should be an important measure which should accelerate the distribution reforms. Now, the key points which are there in the Electricity Amendment Bill are, first, there will be no financial assistance to the distribution companies if they don't privatize the discoms. Secondly, the subsidy has to be through direct benefit transfer. Thirdly, meeting of the renewable portfolio obligations. And fourth, you have to de-license the different distribution circles so that the private operators can come in and service more of industrial and commercial customers. So what we see is that overall, there is a push towards making this overall system more efficient. There are also talks about market-based economic dispatch, where there's a talk about pooling of the power and supplying more economical power to discoms, which can lead to significant savings for the distribution companies. And I see as discoms become more efficient and the AT&C losses come in lower, that will be more efficiency and can be passed on to the customers. So it doesn't require tariffs to be hiked. It is going to be more about reduction of losses of discoms and how efficient we can make them and buy more cheaper power. That's what all these regulatory changes are going to do in the future.
That sounds extremely good to me as a consumer, and I'm sure it'll sound good to investors as well. Reforms and moving towards cleaner power and, of course, more efficiencies on the distribution side as well. Gentlemen, thank you very much. This has been a very enlightening session. Slightly complex subject, but I think now we are better off having heard from the two of you. Thank you for taking all the time and joining us on the CNBC TV18 Investment Guide. And with that, we're completely out of time. Thanks for watching. See you again next week.